Everyone is the quantitative developer. As a quantitative developer, I work closely with the quant researchers and the quant traders at the proprietary trading firm that I work at. I previously worked in the hedge fund industry, and I now work in the high frequency trading space as a quantitative developer. Got a lot of folks asking me, well, what's the difference between the two and what's so special about the HFT, high frequency trading industry? Hedge funds, are quite well known. The business model is quite well known, but HFT much less. I'll explain why that's the case and what's the actual difference. So, let's without further ado, let's dive straight into it. So, I think the primary reason for why HFTs are so little known and hedge funds are way more known is that, well, one, hedge funds usually take kind of clients' money and manage it and try to grow it and provide some kind of returns on it. So that's why a lot of sales, right, and marketing effort goes into attracting clients with a very big amount of capital and locking into that hedge fund by providing a certain return. And so, these people generally don't manage their own money and they manage other people's money, take a fee and kind of provide returns on it, right? So the biggest ones are pretty much the big four, right? I guess you viewers all probably know, but that's basically Citadel, Millennium, Valley. And so you've got this dominated industry. And besides that, you've got high frequency trading, right? And high frequency trading, basically, you cannot invest in it. Like, it's really, really difficult to actually be able to invest in that industry. There's, I think, no opportunities that I'm aware of, and most of the investment opportunities are restricted to either the firm's partners or the firm's employees in general. And so, it's a business model which you cannot invest that usually provides very, very good returns. And the reason why is that proprietary trading firms actually deploy their own capital, their own money, their own resources as high frequency trading firms, right, do, and they don't really need external cash. And a key reason for that is that in a hedge fund, right, if you come up with a strategy, you're going to want to increase your capital, right? Like in principle, you can imagine if you bought X amount of, Apple stock, and then the price of the stock went up, well, the more you get, right? Usually hedge funds are leveraged, right? So the bigger amount that you can bet, your return will scale linearly. Now, there are cases where that does not hold up, because if you trade so much that you trade beyond the amount of signal that you have, so like you saturate the market, you trade such a big amount that you erode your signal away, then you could start losing. But in general, there are now cases, actually, the big four hedge funds, right now, they're not accepting any more outside capital, which is quite a unique situation because there's a lack of talent. So they've exhausted all available signal. But for almost all the other hedge funds in the industry, including smaller ones, there is they're always in looking for cash, right, and trying to raise more, because usually if you deploy more cash, you can get bigger returns on the same strategies, unless, again, you're at saturation, which is the case for the bigger hedge funds. And the high frequency trading industry actually is a similar case as the latter, in the sense that most often you're constrained in terms of signal, in terms of ideas, right? Actually, because there's not that much talent, right? And you're not that much constrained in terms of the amount of capital that you have, because you have a limited amount of capital on HFT, and they're just constrained, right? If you try and trade more, there's just not that much opportunity because you hold for a very short period of time, so you don't get much capital in the first place. So HFT is more like a money printing machine, right? And the hedge fund is more like a money multiplying machine. That's why you get a lot of firms that like start off as hedge funds, or more kind of algorithmic trading, and then kind of deploy more into hedge funds because they want to kind of take advantage of investing all the money that they generated and expand into the business and use some of their signals over there as well. And other firms also do the opposite. Now, other big hedge funds kind of also want to move into the high frequency trading industry. For example, Citadel Securities now is actually the high frequency kind of branch of Citadel, and so they've expanded the other way around. So there is some amount of, like, the biggest hedge funds, the biggest quant hedge funds do actually move more towards high frequency trading as well, because if as a hedge fund you can get better execution, or if you can slightly optimize your trades, you can make a lot of money there, right? Because these people are placing enormous bets on the market. They're going long very big amounts or shorting very big amounts, right, where possible. And so that's why you get that very disproportionate effect. And so that basically explains very logically why hedge funds are so known, because, well, you know, they need clients, they need money, they need marketing, right? They need folks to give them their money. And proprietary firms like HFT firms deploy their own capital, and so they really don't need that much marketing beyond simply attracting a talent really to come to join their firm. And then so that is really the fundamental reason for the discrepancy. I mean, then I guess I touched on this as well, but in terms of like the length of time for which positions are held, right? Like hedge funds hold positions for, you know, potentially, I mean, it depends on the kind of hedge fund, years or longer, right? Months, right? And I mean, high-frequency trading firms, you know, I mean, if it's a much shorter. Like we're talking a very short time scales, right? Intraday possibly even shorter than day traders, right? So that means that they're able to get money quickly with a little capital, generate a lot of returns, and so yeah, I think TLDR that was the difference between the two. I mean, I myself have worked in both industries, so I'd say that when you manage, I mean, when you trade your firm's money, it's always everything is always a little bit more exciting, I would say, than when you trade other people's money, because it's your money, like your firm's money, and then you kind of control everything and you can 100% focus on the actual work. But when you constantly want to kind of get out of people's money, it's always a challenge because there's a very big focus on sales and attracting people to the fund. But it can also be quite fun, right? I mean, you go out on so many dinners and stuff, right? Trying to kind of sell the firm and everything. So that can also be very fun. But after some time, I would say, you know, actually wanting to focus on the work and generating real returns is what matters. Because at a hedge fund, like you might get, I mean, the firm is just going to take like what 20% of the returns to generate, and then you as an employee, let's say if you're a quant researcher, you generated the strategy, you may get an even smaller fraction of that. I mean, if you're lucky, if you get even 50% of that amount, so you usually get a very small percentage, right? And a high-frequency trading firm, it depends on the firm, and most of these stats actually on public firms, the trading firms, simply for the reason that they don't have external systems, so none of that gets accounted anymore, so nobody knows how much money they make, how much money they give to whom, how much their employees get paid. There's no accountability on this because they don't have other people's money, they only have their own money, so there's no information around that. So we can't really know, but you know, we could imagine that it's higher. It's very interesting because actually reading an article recently where they mentioned that the whole size of the high-frequency trading industry is somewhere around 30 billion annually, right? That's nothing, right? I mean, a hedge fund alone, some hedge funds alone hold like, you know, over 100 billion. So that's nothing, right? It's just a much smaller industry, but much more profitable for the individuals in there. So yeah, that's basically it. I started this channel to just, you know, kind of digest publicly available information about the HFT industry because there's not that much about it out there, and just kind of post it out here for educational purposes. So if you guys want to be part of the community, I recently launched the QD network, Quant Developer Network, on Discord, so the link is going to be in the description. But yeah, if you want to join, feel free to join, and also subscribe to the channel so you don't miss out on the latest videos. And yep, take care everyone. Bye.